Good morning, everyone. So welcome to our 11:15 a.m. Monday morning webinar. So today we have stock counter update for OCBC's Investor Day in Hong Kong on the 13th and 14th of August, and also the macro and sector outlook for Phillip Singapore, as well as technical analysis for STI and Walmart. So first, we'll start for OCBC's Investor Day. So for the gist of the Investor Day in Hong Kong, it's mainly for the creation of franchise value in Greater China for OCBC. So from figure 1, you can see that profit before tax by geography showed earnings from Greater China tripling in 5 years. So the reason why they showed FY13 as compared to FY18 is because they acquired Wing Hang Bank in 2014. So FY13 is a clean figure without Wing Hang Bank. So as you can see in FY13, Greater China only contributed 6% to the total PBT. And 5 years later, Greater China increased to 19%, with 9% coming from Wing Hang. So the acquisition of Wing Hang is actually creating franchise value for the OCBC group. And based on figure 2, they further explain what creation of franchise value means in quantitative terms. So in figure 2, you can see that in 2018, operating profit was 1.6 billion as compared to the previous slide of 1 billion from Greater China. So the difference of 600 million is what they call creation of franchise value. So the 600 million is actually the additional earnings that are generated from outside of China that is included in the management reports of Greater China franchise. And for OCBC, they executed its Greater Bay Area, in short GBA, strategy in 2017. So this is mainly for Hong Kong, Macau, and the Pearl Delta region. And moving forward, the group will be expanding its strategy to focus on 3 key areas in Greater China. So mainly it's the Jing-Jin-Ji region, Yangtze River Delta region, and the Greater Bay Area, which is what they are focusing on right now. So they expect synergy between the group's Greater China franchise and ASEAN franchise as they capture flows from supply chain repositioning in these 2 regions. So the GBA registered PBT of 600 million in FY18. So this made up around 60% of Greater China's PBT for the group. And they target to increase PBT from the GBA region to 1B by 2023, and that's 5 years later, representing around 5-year CAGR of 11%. So this will be supported by the target loans growth of 12% per year to reach 80B by 2023. So Hong Kong remains as a core contributor to OCBC Wing Hang. And from figure 5 below, you can see that Hong Kong contributes 73% of the total PBT for Wing Hang Bank in FY18, followed by China and then Macau. So OCBC Wing Hang's 2017 growth strategy includes 2 areas. First is to increase the existing as well as new customer franchise, as well the other area is to improve productivity. So they merged the 2 China entities, OCBC China and Wing Hang China, to form OCBC Wing Hang. So this merger streamlined processes, which resulted in the cost-to-income improvement of 5.5 percentage points in just a year between FY17 to FY18. So in figure 6, it shows how increased connectivity between the 3 legal entities, basically Bank of China, OCBC Wing Hang, as well as OCBC Group, created deeper penetration into the Greater China franchise. So AUM, revenue, as well as AUM per client tripled in just 5 years. And moving on, they shared about integration of capabilities between Bank of Singapore, which is more of the private wealth management business, OCBC Wing Hang, as well as the OCBC Hong Kong Group. So the increased connectivity between these 3 created a more comprehensive suite of products that they could provide to their clients, as well as greater cross-referral of clients across different banking units such as consumer, corporate, IB, treasury, and private banking, and as well as across regional franchises. So OCBC Wing Hang's single integrated platform is also one of the differentiating factors. So unlike Wing Hang's Hong Kong competitors, OCBC Wing Hang's different approach is to serve both the SME business and individuals within the same branch. So previously, SMEs have to travel to a specific SME branch to obtain SME services such as loans or restructurings. Now, they could be directed to a more convenient retail and consumer branch, and this actually proved effective from a 5 times increase in new-to-bank customers, as well as a 50% increase in SME customers. And in addition, another interesting fact that they shared was that 53% of the SME customers are also their consumer customers, which is one key area that OCBC has been trying to improve on in the Hong Kong franchise. And for corporate banking synergy, Bank of Singapore and OCBC Wing Hang, now that they are both having increased access to the entire product suite of the group, it opens doors and provides support for corporates across the region as they expand their businesses. So this resulted in a 5 times increase in referral income, as well as 3 times increase in treasury advisory and 10 times increase in corporate wealth management in just 4 years. And relationship stickiness is also one of their strengths, which resulted in 2 times increase in revenue per customer. So figures 7 and 8 is just mainly some statistics that they shared with us on how greater productivity and as well as synergy benefited OCBC Wing Hang's banking franchise between 2014 since acquisition of Wing Hang to FY18. So overall, we maintain accumulate for OCBC at a slightly lower target price of $12.32. Previously was $12.50. And this is mainly due to our lower credit costs, increasing our credit cost assumptions to 23 basis points. Previously it was 20 basis points, and our lower loan growth target of 4%. And this is mainly due to 2 reasons. First is the US-China trade tension, which we expect may result in some deterioration asset quality and more provisions along the way, as well as additional risk of lower loans and fees growth as investors' appetites wane. And the other reason is the recent unrest in Hong Kong. It brings uncertainty in business and investor sentiments as well in the short to medium term. So these 2 factors made us have more a conservative estimation in our credit costs as well as loan growth for FY19. So during the Investor Day, OCBC does not expect the protest to pose as a threat in the medium to long term, because banking businesses is what they look at the medium to long term aspect, and the protest is expected to be resolved in the short term. And OCBC does not expect its target set for now to change, and suggested no noticeable increase in outflow from Hong Kong because of the recent events. Hence, overall, we are positive on the continued growth in OCBC's Greater China franchise, and China remains as the largest economic generator in Asia as well. And OCBC's market share in Hong Kong and China is still quite minimal, and this means that there is still room for growth, especially quality loan growth, without affecting the credit quality. In fact, Greater China's non-performing loan ratio is the lowest in the entire franchise at 0.5% for Wing Hang Bank, while the group NPL ratio was at 1.5%. So that's all from me. I'll pass on to Wei Ren for STI technical analysis.
All right, now I just do the Straits Time index for the technicals. So for Straits Time index, previous sharing we shared that price rejects strongly on the resistance at 3,004, and our view is still the same based on 15th of July. And price as of last week, it has a strong rebound of the demand level, which we predicted that price will come down eventually. And for this, we are still maintain our views that there's a series of prolonged running flats to go on, and price has actually completed the wave W faster than we thought. So we might see a potential upside for the prolonged period till the wave to form wave X. So however, there is also a possibility that price may break below the range of 2,900. If the price do break 2,900, then the next price target will be at 2,800. Move on to Walmart. So for Walmart, it's expected to rise further due to a strong uptrend of higher high and higher lows, and both primary and secondary trends are still intact. Price has been rebounded strongly. Let's move on to the recent period that the bearish engulfing actually closed above the 2 support region at 110.203 and 106.312. And on top of that, bullish engulfing close above the 22 SMA indicate a strong bullish sentiment ahead. And if we look at the chart pattern, right, there's a ascending triangle formation. So we expect price to retrace a bit to the back to the support one, and then break off thereafter. So now I move on to Paul for the Phillip Security Weekly.
Thanks, Baron. For this week, we actually have less things to discuss. This will be the last section. Okay, anyway, I'll move on to our weekly updates. In terms of the Singapore macro, I think the volatile industrial production numbers coming out from Singapore was down about 0.4 in July. It's much better than what we had in the prior month. There was a massive 8% fall in our industrial production. Nevertheless, it's still weak. We're still having a negative. We're still having a contraction. A positive in terms of the bank loans. I think Mini will issue a report soon. But anyway, in terms of bank loans, just to give you a flavor, bank loans were stable in Singapore, about 2%. Because there wasn't really much macro news. If we swing to Hong Kong, since that's the highlight of the month at least, the retail sales in Hong Kong actually dropped the most in 3.5 years by 11%. I think the bulk of it was in the luxury goods. It's still a contraction compared to the prior month in June, which was down almost 7%. But in terms of the banking sector, that's still holding up reasonably well, I guess, in terms of the loans at least. It actually crept up marginally to 3.6% compared to the prior month of 3%. In terms of the fiscal, the topic right now, at least the macro team right now, is beginning to see more and more fiscal spending by multiple Asian countries. Obviously, there will be more rate cuts too. I think most recent, I think the 1 or 2 weeks ago, we had Thailand announcing they're going to undergo some massive fiscal spending. So for last week, we had South Korea mentioning that they're going to raise the fiscal deficit. And also the big macro for the region is, of course, India came up with a GDP which is the slowest in 6 years. They too are looking to lower interest rates. So the theme in the region is at least more fiscal spending and lower interest rates. In terms of our tactical view, obviously it's still bearish. I think the trade or tariff war, we don't see any reason for resolution. We just run through a slide later. And even if we do get a Fed cut in 1 or 2 hikes this year, I don't think it'll be suffice to at least pacify the markets. I think the markets are still pricing in some recession with the extremely low rates. And again, the view is obviously the lower rates won't revive any growth. In terms of what we think is still attractive, I think no change from the prior week. I think thematically, again, from top-down basis, we still like the SGX listed US REITs. I think the yields are superior, almost 6 to 7%. And of course, you got a favorable currency. And as you know, the US dollar looks especially strong against the Sing dollar on relative growth, and with the monetary policy statement coming up next month, where we expect MAS to actually make the Sing dollar at least modestly weaker or at least flat. And of course, you got the RMB overhang on all Asian currencies. In terms of the news for next week, I think by today we're probably going to get a lot of the global PMI numbers coming up. And also by 6 September, we're going to get the US jobs data. So probably those are the two big data points. In terms of others, I think on Halloween Day, probably on 31st October, you're going to get a triple, like reaching our, probably going to get Brexit, Draghi leaving, and also the Japanese VAT, which some are prospecting that if they when they impose the VAT, it could be another onslaught of a recession in Japan. But anyway, we don't cover Japan, but anyway, this is just the talk. Anyway, I'll move on just to our next slide. This is how we always portray about what are the pressure points on President Trump, at least if he wants to resolve the tariff war. So far, as you can see from here, the only 2 things that are pressurizing him is the farming sector. As you can see, delinquent loans in agriculture continues to rise sharply. I think the farming sector is extremely big, and this is, of course, an important vote base for him. The other part is, of course, farm incomes out of the US, you can see from this chart, is continuing to fall. But I think he's placating all this weakness through providing a lot of direct farm aid in terms of billions, and also what he's doing is and even trying to propose such things as a huge ethanol, compulsory, a higher blend of ethanol and so forth. So he's putting on a lot of benefits for the farmers to actually placate this weakness right now. So that is not really a major pressure point for him. But of course, the other pressure point, as you note, he always tweets on the stock market, always claiming since its election, the market is up almost 50% and it's record highs. But again, the market in the US is only 3% off the high. So another no real major pressure for him to try and go back to the Chinese trend and trying to stroke up the highest stock market since it's only off its lows. And the other part is, of course, the approval ratings for Donald Trump. It's, as you can see, it hasn't really deteriorated much. And it's actually quite stable. So again, all this, if you look at these four charts, there isn't really any major pressure point on the president to actually push through a tariff deal with China. So that's why we're not optimistic of any deal coming through soon. And of course, this is just the last slide. This is just the last slide. This is our usual Phillip model, absolute 10 model portfolio. So we were down about 4, the market was down about 6. So we still outperform. In terms of what has done well, or what hasn't, in terms of what has done well, I think the yield stocks, especially and also those selected growth or very defensive growth like Sheng Siong, is because it's, most of the products are groceries and so forth, so probably be deemed as defensive. And of course, Netlink is the other defensive that's outperformed. And what has performed badly, of course, most of the banks have done poorly, apart from SGX, because of the derivative benefits. Okay, I think that's it for us right now. If there are any questions, it's a bit light today. Thank you. If there are any questions, I can post them. Thanks.
Hi, we have a question regarding the current situation of Hong Kong. Will it change our estimates of OCBC's earnings? So right now, the situation for OCBC's side, they haven't given any indication or guidance yet whether it will have significant impact. So we hold our earnings forecast for now, and we did have a slight adjustment for our credit cost assumptions to 23 basis points, as well as lowering our rooms growth estimate. So we were rather conservative in this aspect, and that is not just because of the Hong Kong situation, but because of the trade war tension as well. As a result, our target price was slightly lower at $12.32. Previously was $12.50.
Hi, there's a question on what's the view of the US market since it went up last week. So I think right now the trade dispute with China may be escalating, but despite the concerns of the Fed, I think there's not much evidence to show that there's going to be a significant impact on the economy. So for the direct impact of these tariffs, I think that it should be manageable, although there is some risk to the data, especially with, I think for the durable goods report released this week, it showed that the underlying capital goods shipments have fell sharply in July. But then if you look at the revised GDP data this week, we showed that consumption has surged 4.7%. Retail sales is still going very strong. So we think that going forward, we also expect that the ISM manufacturing activity surveys to probably rebound in August. So in terms of the US market, we think that there's still growth and there's still growth in the earnings to come. And we think that it's very unlikely that there's going to be a recession for at least the next quarter.
Hi, there's a question on my title regarding the title. For the bullish rise is referring to this. As I mentioned earlier, there's a strong rejection of the weekly chart on the demand level. So we are expecting the STI to make a true wave upwards to the supply level to form wave X. I don't know if that answers your question. Thank you.
There's no further question. We'll end our Monday morning webinar now. Thank you for tuning in.